Hi, good afternoon. This is the consensus of world prediction for 2025. Environmental issues will get center stage, and most people believe Ukraine and Middle Eastern conflict will come to an end. Globally, after 2008 subprime crisis and COVID-20, now countries are mending their fiscal position, and deficit in most countries is on the way down. As fiscal deficit started coming down and inflation started falling, many central banks around the world are giving rate cuts across both developed as well as emerging markets. There are some exceptions like Japan and Brazil, which are raising rates. The real challenge is, despite fiscal and monetary situation, the challenge remains on the PMI side, which has remained below 50, below expansionary for some time. We believe, despite many rate cuts, more rate cuts should happen in the days to come. US and China seem to be on collision with tariff war, and while US has large deficit with China of about $350 billion, China is not dependent on US to that extent. In the past, US has raised tariff at various points of time, and we believe they will continue to wield the weapon of tariff in the days to come. There are fears that a 10% US tariff hike could impact China's GDP by about 50 basis points, or about 10% of their current GDP growth rate. China has a challenge of debt. Their debt burden today as a percentage of GDP is higher than both US and Europe. Next slide, please. China economy has done very well, but because of capital allocation inefficiency, their companies haven't done as well from a profitability point of view. This is third year in a row where Chinese corporate profits will decline. Coming to US economy, Fed has maintained a very delicate balance by raising interest rates quickly, but taking away liquidity slowly and steadily. This application of accelerate and brake together has ensured that American economy survives the current situation. Next slide. As of today, US has trade deficit of 123% of GDP, and for every $1 of increase in debt, they are able to create only 58 cents of GDP. Undoubtedly, US needs to keep on borrowing money to fund growth. If your debt goes higher, you need lower interest rates. And we have seen how US debt has gone up and interest rates have come down. But next year, US will have about $10 trillion of its debt coming for rollover or maturity. If this debt gets rolled over at higher rate, it will have serious fiscal implications for US. Not deterred by US debt, Investors have pumped more money in US than they have put in rest of the world, including countries like India and China. This gap of almost 6 times money coming to US market over other market has resulted into their market cap becoming large percentage of global market cap. The US market looks expensive, and as of today, the gap between US earning yields and bond yields are in negative territory. US economy is roughly about 20% or one-fifth of global GDP, but their market cap has steadily increased to become 65% of global market cap. Can this sustain? Everybody is asking this question. If we see the action of corporate insiders, they are selling shares at a record pace. Normally, when insiders sell, they are not very bullish about future return. Next slide, please. Coming to Indian economy, the headline have been mixed. Service PMI witnessed a little bit of drop, but auto sales picked up in January. E-way bill generation hit a lifetime high. Overall, if we look at our economy, we are in a reasonably good shape. We will remain one of the fastest growing major economy in 2025 as well as 2026. Our economic activity has steadily gone up, and there is a small uptick after September 24. Capacity utilization generally tracks PMI manufacturing, and while PMI manufacturing has come down, it is still above 50, which is expansionary zone. So this gap does give confidence that at some point of time, manufacturing capacity utilization will start inching up. Monsoon has been very good, and this has created bumper kharif crop, and the reservoir water levels are also above 10-year historical average, which bodes well for Rabi crop. The rural demand based on good agriculture has started improving better than urban demand in last couple of months. Fortunately for India, the crude oil prices have remained subdued despite all geopolitical uncertainty. And as long as it remains within $70 to $80 band, we should be fine. One good thing last month was increase in GST collection above nominal GDP growth rate. From May 24 to December 24, GST collections were growing at lower than nominal GDP. Now, at least we are seeing in the month of January, nominal GDP, GST collections growing above nominal GDP. India Inc. balance sheet continues to remain strong, cash flows have improved, and debt has come down. As India's debt leverage has come down for corporate India, we believe capex cycle should pick up over a period of time. If we look at banking approval for private projects, From COVID time to now, there is a 20% CAGR. Hopefully, these sanctions will get converted into actual project on ground. The government capex, after a slowdown during April, May, June, July 2024, has now in the month of December exceeded previous year's number. Hopefully, we will increase the spending to ensure that the revised estimate of budgeted capex is achieved at 10,20,000 crore. Capex, after a slow start in April, May, June, July, has started picking up pace, and we should be able to achieve 10,20,000 crore revised estimate in this year. Our economy does have some weak spots. One could be our commercial vehicle demand, which in FY24 will be lower than 2019, or even two-wheeler and three-wheeler, which are lower in 2024 than 2019 pre-COVID time. The two and three-wheelers and commercial vehicle segment continues to remain well below its historical high. The other challenge is Ladli Behna scheme across the state. No matter which party is fighting election, they all promise freebies. Right now, 2,17,000 crore worth of freebies are distributed under state cash transfer scheme. And this is only in few states like Maharashtra, Telangana, Karnataka, Bengal, and MP. If this becomes bigger and bigger, it will have implication for India's growth as well as stock market valuation. FDI inflows have come down sharply as a lot of private equity venture capital funds have taken their profit out. On a net basis, monthly FDI inflows have kept on shrinking, especially because people have taken money out of India. Companies like Hyundai, LG, Whirlpool, if they take money out of India, the net FDI numbers continue to fall. As per Lama research, 60% chances that Indian economy will do well and 40% chance that we may not do as expected. In our opinion, growth will be somewhere around 10% nominally, and inflation will be somewhere around 5% nominally. We should be in this bracket, this place for next probably 1 or 2 years. In this context, budget has been fantastic. It has given Triveni Sangam of fiscal prudence, with fiscal deficit coming below 4.4% next year. It has also focused on consumption, whereby 1 lakh crore tax rebate has been given to taxpayers. And at the same time, the focus on capital spending continues. This is truly a Triveni Sangam of increasing capital spending, giving boost to consumption, and yet maintaining path of fiscal prudence. Capex number next year will grow at 17.4% if we take into account grants and loans. This budget has provided a jump of about 1,50,000 crore through zero coupon 50-year loan if state does capex. Let's hope next year we are in a position to spend 15.5 lakh crore between center and state for capex. If expenses have been increased, consumption boost has been given, then how come fiscal deficit has been maintained? Is there a magic there? Well, normally tax collection moves in line with nominal GDP growth. This year, we are assuming that gross tax collection will move by 13.5% after adding back 1 lakh crore tax rebate. Nominal GDP is expected to grow at 10.1%, which means the tax buoyancy ratio will be 1.33 times. Last year, that is FY25, tax buoyancy ratio was 1.1. How do we move from 1.1 to 1.3 will be very, very critical. This growth could happen by taking last naya paisa out of existing taxpayers, or this can be taken by bringing new taxpayers into tax net. This budget will also see sharp increase in dividend income, especially from RBI. And even if we don't achieve taxation revenue estimate, divestment can increase from current 47,000 crore budgeted. Markets have gone up, but divestment has come down. This gap can easily help in managing fiscal prudence if taxation revenue drops. The good thing in the budget is investment for future. 10,000 crore given to SIDBI for investing in new ventures. Hopefully, many more Zeptos, Swiggies, Zerodhas, Grows of like unicorns will be born. We are spending 20,000 crore for small modular nuclear reactor. We depend on oil and gas for our energy security. We are one of the largest importer of oil and gas in the world. By investing in small modular nuclear reactor, we should be able to fast track nuclear energy, and that will give us some security on energy independence. We import $1.3 trillion worth of, we import and export $1.3 trillion worth of goods, $850 billion import, $450 billion export. Collectively, we spend 30, 40, $45 billion in logistics and shipping cost on exports and imports. While giving 35, $40 billion to global shipping companies, we could have easily kept that in India by building ships and using that for exports and imports of goods. This budget, 25,000 crore is allocated for goods, for building ships, for maritime development. 20,000 crore is allocated for deep tech innovation. China developed DeepSeek, albeit not at $6 million, which they are claiming. But the fact remains that they have developed deep tech across many fields like AI, ML, renewable energy, electric vehicle, and so on and so forth. Hopefully, this investment of 75,000 crore in future will hold well for our economy in the days to come. Other good thing is focus on education sector. All government schools will be given broadband connectivity. They will have innovation labs, and their entire curriculum will be digitized so that students can access best of the books on the subject which they are interested on their smartphone and tablets. Collectively, this focus on education sector will ensure that we produce more employable and knowledgeable students. 1 lakh crore tax rebate has been given. It's a recurring, as every year that benefit will stay. Maximum 7 to 15 lakh income bracket people will have this benefit. They are unlikely to spend money on roti, kapda, makan, which is consumer staple. They are more likely to spend on travel and tourism, healthcare, and entertainment, which is consumer discretionary space. We remain bullish consumer discretionary space in view of this announcement. Outside of budget, सबसे बड़ा रुपया. For growth to pick up, RBI needs to provide durable liquidity and they have to start cutting repo rate. Aim is to ensure that credit is available for supporting growth. In Mahabharata, Abhimanyu went into Chakravyuh on his choice. He was only fighting Kauravas. But our modern day businessman is Kalyug ka Abhimanyu. He is born in Chakravyuh and he has to fight not only Kauravas but also Pandavas. They are burdened with 26,000 compliance burdens. Jan Vishwas bill is cutting down 180 such laws. Jan Vishwas 2 will take another 100 laws out. Clearly, we need to remove more such compliance and regulatory burdens from our employers, from our entrepreneurs back. Coming to equity market, against average market cap to GDP ratio of 87% over last 20 years, current market cap to GDP ratio is 132%. It has remained high in post-COVID era. It has remained high because profits have jumped from about 4 lakh crore in FY20 to 15 lakh crore in FY24. And from 15 lakh crore over next 2 years, profits will jump to about 18 lakh crore. When profit grew 26% between 2010 to 2021, market delivered 84% return. But when profit jumped 327% between FY21 to FY26, markets delivered 275% return. Stocks are slave of earning, and as long as this numbers keeps on improving, I think our markets will be in good state. Valuation wise, large caps are trading at 6% premium, mid caps and small cap at 24 to 32% premium. Large cap looks more safer from a valuation point of view than mid and small cap. In the first 6 months of current year, Nifty EPS has touched 509 rupee. It is estimated that in second half it will increase by 524 rupees to have Nifty EPS of 1033 for FY25. That will be a growth of 4.4% over 1005 EPS of last year. Most importantly, year after that, market is expecting 15% earnings growth and Nifty EPS to touch 1177. If this numbers indeed gets achieved, then there is limited downside to the market from a valuation point of view. FPIs have been large sellers. In the month of November, they sold $11 billion. In the month of February, they sold $8 billion. Collectively, they have sold close to $20 billion in last 4 months. FPI selling is not just across India, it is across emerging market. Taiwan has been sold into, so is Brazil, so is Indonesia, Philippines, South Korea, Thailand, and South Africa. China hasn't published numbers since October 24 of how much FPIs have sold. That being the case, it's quit emerging market movement across the globe by global investors. Partly, FPIs are sellers because they are taking money back to America. There is Ghar Wapsi happening. SoftBank announced $500 billion investment in America when their CEO Masayoshi Son met US President. If SoftBank is going to take money to America, quite likely emerging market countries like India is a sufferer. Should we sell equities along with FPIs? Should we move into cash as FPIs are selling? Well, answer is we don't know how long FPIs will sell. While on the face of it, it looks like they're likely to be selling for some time. Let's look at the data which gives confidence to hold despite their selling. Emerging markets outperform US between 98 to 90, between 89 to 94. But next 10 years, US did very well. From 90, next 3 years, US did very well from 95 to 98. Emerging markets outperformed from 99 to 2010. It was a golden decade for emerging market. But thereafter, US took over and started outperforming massively. Looking at the past history, emerging market has become very, very cheap vis-a-vis developed market. FPI outflows are about $20 billion. It's just 0.3, 30 basis point of their portfolio. They are long-term committed investors to India as their $800 billion market value of holdings suggest. While FPIs were seller in large cap, they were buyers in small cap in last quarter. This behavior of FPI is quite unique because only promoters and other foreign entities, which is probably linked to promoters, are sellers in small and mid cap. Rest all of the players, be it mutual fund, be it FPI, be it insurance, be it individuals, be it other domestic institutional investors, have all bought into small cap and large cap. Domestic institutional investors inflow remains very strong and they are pumping money whenever there is correction. DIs have between cash and allocation in balance advantage multi-asset allocation fund category, roughly 2,75,000 crore worth of liquidity. This money can be deployed in case market becomes extremely attractive. That's a firepower of about $30 billion in case push come to shove. Our share of global market cap to GDP ratio is down from 4.6% to 3.9%, somewhere around what is India's market share in global goods and trade exports. India's valuation premium over emerging market is now below 5-year average of 72% at 48% because of this correction. More importantly, FIIs are now underweight India At one point of time, they had more than 20% ownership in Indian equity. Today, it is just about 16%. They have come down from their peak holding by about 16. They have come down from their peak holding by about 5 to 6%. Look at this chart carefully. China today trades where it was trading 17 years before. Over last 10 years, their earnings growth is 10% in renminbi terms. On the other hand, US has grown multiple times their earning at 114% in dollar terms over last 10 years. India is also not behind, as they have grown rupee earnings by 169% in last 10 years. If we look at India's sectoral comparison vis-a-vis rest of the emerging markets, we provide diversified portfolio. The only caution while investing is to remember that last 5 years have been exceptional. Almost 290 stocks out of 500 stocks have more than doubled in last 5 years. Today, 180 stocks are trading above 50p, showing that there are some pockets in market which are looking expensive. One will have to moderate return expectation going forward. Last 5 years, equity markets delivered 17% return, led by small and mid cap at 20 to 25% return. But 15 years before last 5 years, large cap and mid caps had delivered just about 11% return, and their broad market delivered return of about 11%. Going forward, these returns are unlikely to happen, and you will see this kind of returns over next couple of years. If we look at growth as per market capitalization, in last 5 years, large caps are up 3.8, but micro caps are up 7.3 times, showing there is a risk appetite among investors. It will be fair to say there will be more volatility thanks to President Trump's announcement, and markets will continue to watch oil prices. Will it continue to fall or will it bounce back? Is corporate India able to deliver 12-13% return on investment? Geopolitical risk remains high, especially with President Trump making more and more dramatic announcements. Consumption should get boosted with 1 lakh crore tax rebate. And most importantly, with Delhi election, market will be confident about stability of the government. At this point of time, our view remains we should be overweight large cap and underweight small cap, but with neutral allocation to equity as an asset class. This is not the time to be leveraged. This is not the time to be fearful in dumping our portfolio if we are underinvested. Next slide, please. The large cap contribution as a percentage of total market cap has declined from around 75% plus to 60%, it shows that large caps today provide value. Price is what you pay, value is what you get. If you invest at higher P, your returns will have to be moderated. If you invest at lower P, then your returns could be on the higher side. Buy cheap, sell expensive is easy to say, but difficult to do. At least at current point of time, we are somewhere in the middle territory, away from high P and also away from low P. From an equity market point of view, majority of our equity funds have delivered positive alpha over benchmark index on a rolling return basis. Next slide, please. Across our hybrid and other equity fund, we have outperformed benchmark indices and added value to our unit holders. Next slide, please. If we look at point-to-point return, barring few exceptions where our returns are lower compared to benchmark index, overall we have delivered better return than benchmark index across majority time periods, across majority fund. Next slide, please. Even in hybrid funds, we continue to maintain outperformance over benchmark index. If we look at SIP across majority of index, across majority of funds, bearing few exceptions, we have added value to the investors by outperforming benchmark index. This number should be in red, not in green. Across all our hybrid and equity funds, experience has been similar. Next slide, please. At this point of time, we believe a large cap fund, a large and mid cap fund like Kotak Equity Opportunities, a value-oriented fund like EQ Contra, or a blend of large, mid, and small multi-cap funds will be appropriate. Kotak Quant Fund is an Harfanmola fund which uses man and machine together to generate return. That also one can look at purely from a momentum point of view. Sectorally, consumption and banking and financial services fund looks good. Technology also looks good from a thematic point of view. We also have presence in passive space. It allows you to copy an index, gives you diversification, is very simple to manage, and transaction costs are relatively lower in passive fund over active fund. Next slide. Our bouquet of passive fund includes index fund and ETF across various themes, from momentum to low volatility to alpha to value to equal weight indices. If we look at thematically or sectorally, we have n number of funds covering major sectors and themes. Most of our funds on passive side has lowest expense and consequently lowest tracking error. Coming to fixed income market, US inflation has declined to Fed's comfort level of around 2%. Next slide, please. Fed has deferred rate cut in this policy, but hopefully going forward, there will be shallow rate cut cycle between, let's say, 50 to 75 basis point in India. Dollar index, dollar index is driving emerging market outflows. And there are people who believe now dollar index will start cooling off, and that could give some respite to FPIs who are hell-bent on selling their investment. In the net borrowing side, for last many years, borrowing has remained in 11 to 12 lakh crore range. This year is no exception, and we believe net borrowing shall remain under control for some time. Our CPI inflation has cooled off as food prices have come down. RBI expects inflation to be around 4.8% this year. They have increased liquidity through buy-sell swap, through open market operation, and they have also cut interest rates by 25 basis points in this policy. Undoubtedly, RBI seems to be more focused on growth. In the credit policy, RBI cut repo rate by 25 basis points. We expect another 50 to 75 basis point rate cut in the days to come. In RBI's estimate, FY25 inflation will be 4.8%, and thereafter it could come down to 4.2% in FY26. Growth forecast will be 6.7% real and about 10% nominal, despite local and global challenges. RBI has managed liquidity quite nicely, and despite daily liquidity coming under pressure, they have ensured open market operations to provide adequate liquidity to banking system. We believe this is time to buy long duration with 12 to 18 months view. It should deliver not only coupon income, but also capital appreciation. Coming to debt investment, income plus arbitrage fund of fund gives you tax rate of 12.5%. For people in higher tax bracket, this is very good fund. The allocation of this fund is 60% debt, 40% arbitrage, and combination creates 12.5% tax payable on capital gains, long-term capital gains made after 2 years. Our hybrid and debt funds continue to do well. They have added huge alpha over the years. If we come to the gold prices have run up substantially. We started giving bullish call on gold in March 20, except 2021, where gold didn't do as well. By and large, this call has worked out very well. Going forward, we believe gold prices will get supported. Next slide, please. As China continues to buy gold to diversify their massive FX reserves, and more importantly, they have allowed their insurance companies, which are managing about $4.3 trillion of assets, to buy up to 1% in gold. That will be additional demand of $43 billion. Physical gold is difficult to get in markets like New York and London. This clearly shows on the FNO someone has delivered more gold than they probably would have imagined. While gold prices have gone up, gold's holding in FX reserves of central banks have actually come down. Whenever US cuts interest rates, gold prices get supported. We believe going forward, US will be looking to cut interest rates further, and that should be positive for gold prices.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.